All right, committee, welcome. Appreciate everyone being here, both here and online, so thank you for that. We would start with any bill introductions. And I might ask if there is a way. Are you able to hear us, Emil? Hear nothing. All right, we'll work on just a moment to make sure we're getting sound. One of the challenges that we had, and I know it was the camera, and I think we were even having trouble with the sound working. For the moment it was working during our first meeting, we had to close it. So, wasn't working? Gotcha. So then the question is this room bigger than that room? Check 1, 2, are we working in both rooms? Okay, so they can hear, and then how do I hear them if they have something to input? Is there any way I see raised hands from that room? So if that's on the screen, that would be helpful. Yeah, so, and then we will be ready. So just a few announcements while we're getting that going. I'll move back to bill introductions. One of the things we had done last week, we had passed out the date change bill on the consent calendar. Some of you may have seen that the consent calendar is not a route that we're planning on going with both bills, just because it would take 3 weeks in our current setting to pass them. So it is possible, maybe likely, that that bill will be waived off tomorrow. We're just trying to figure out, do we go ahead and waive it off so we can work it next week, or do we just wait 3 weeks until it would come up on the consent calendar? I'm pretty much indifferent to whatever our leadership team thinks works the best to get bills through, because that was our only goal, was to make it easy to get through, and no big deal beyond that. All right. I am now at least seeing several folks who are online. I can see the committee room, but you'll have to wave big to get good attention, because you're one of the smaller blocks on the screen. I know Chris will help me watch that also.
Mr. Chair.
From there, although that's changing for us, so we'll be in great shape. Are there any bill introductions to come before the committee? I think seeing none, we will move on to the next item. And with that, we will be working bills on Monday. We will not go ahead and work them today, in that we did not have it announced. We will want those worked on Monday to try and get things out as we can and not create too much of a backlog of bills. So that will include the licensing bill, number 2074, and the death benefit bill, which is 2063. So plan on working those right off the bat on Monday, and perhaps some of those bills that we hear today in addition. With that, we'll continue with our overview of CAPERS, and I would welcome Director Conroy.
Thank you, Mr. Chairman. Glad to be here, and glad to see there's lots of interest in CAPERS information on a Wednesday afternoon, sort of late in the afternoon. I do have lots of information. I'll go through it at a pretty good clip, but certainly, as the chairman so directs, glad to take questions either during the presentation or at the end, whatever works out best for that. So today I'm going to talk about CAPERS, the retirement plans themselves, give you some system statistics, and then just talk a little bit about key terms in terms of the sort of the pension world, and what are some common terms from that perspective. On slide 4 of my presentation, it's just a reminder that CAPERS only exists for one purpose, and that's to serve our members. We have a staff a little over 100 now, and there's actually 3 statewide defined benefit plans for public employees. The CAPERS plan that a lot of people think about, then there's the police and fire retirement system, and then the retirement system for judges. CAPERS, we partner with over 1,500 employers. So of course, the state of Kansas, all the local school districts across the state, all the counties across the state, almost all the cities. The one notable exception is the city of Wichita is large enough to have their own retirement plan, so they're not affiliated with CAPERS. But then you get into all those other sort of public entities, so it might be a township, might be a drainage district, could be a community college, conservation districts, all of that. So there's 1,500 employers then that we interact with on a very regular basis, certainly every payroll period that they have, whether paying bi-weekly or monthly or whatever it may be. On slide 5 is just the CAPERS Board of Trustees. It's a 9-member board, 4 appointed by the governor, 1 appointed by the Speaker of the House, 1 appointed by the President of the Senate. The state treasurer is on by virtue of the office. And then the members get to elect 2 trustees, 1 on the non-school side and 1 on the school side. And both active and retired members get to participate in that election. And this spring, in fact, there will be an election. We only had 1 candidate on the non-school side. The incumbent, Ryan Trader, was the only one who filed, and he's a firefighter paramedic, and you heard from him on Monday on that KPNF bill. But he's the only candidate filed, so there'll only be election later on this spring on the school side, and 2 candidates have filed that, the incumbent, Ernie Claudel, and then an active member applied. On slide 6 then is just the mission, and again, it's all about serving our members. CAPERS has that fiduciary responsibility, which is that legal, moral, ethical responsibility to always do what's best for our members, and that has to be our guiding force as we carry out our day-to-day business. And so we hold those assets in the CAPERS Trust Fund, we grow them through investments, and then when the member is ready and entitled to a retirement benefit, we are ready to, we have those assets to deliver those promised benefits. And so you can just see some of those numbers. It's a big operation. I think, like maybe I've mentioned, I always used to say we're in sort of a nondescript building on Kansas Avenue. Used to be next door to Slotsky's until Slotsky's closed. So now I say we're either across from the new Evergy Plaza or down the street from Wolf's Camera Shop. A lot of people know where that is. But from that building, then we do all this service. We manage those investments. Just things like we pay out almost $1.9 billion a year, and that's with the BEAD, so that'd be retirement benefits, death benefits, withdrawals. So just things about, in terms of count updates, over 90,000 of those in a year. We answer over 90,000 phone calls, over 20,000 emails. So lots of interaction with our employers and our members. On slide 7 is just, we're qualified, it's called a 401A defined benefit plan, and that's important because it keeps us square with the Internal Revenue Code. And so we're compliant, all of the CAPERS statutes and framework keeps us square with the IRS, which then allows some tax advantages since we're a qualified plan, as it's called. And so those member contributions are picked up or excluded from taxable income for federal income tax purposes. And also but then some of the other things in terms of benefit changes or modifications like working after retirement withdrawals, those always have to be, or we check those through that lens of IRS compliance. And we have separate IRS tax compliance firm. It's a firm called Ice Miller out of Indianapolis, and they specialize in IRS compliance for public pension plans, and so we work with them very closely. On slide 8 is just the reminder that there's 3 retirement plans. There's that KPERS plan, state and local, most of the 1,500 employers, over 309,000 active, inactive, or retired members are covered. So that'd be those state employees, those local school employees, and then all those other local public employers. Police and fire, of course, public safety covers police officers, firefighters, emergency medical technicians. It's up to the employer if they want to affiliate with police and fire. There's a higher employer contribution than in regular KPERS. And so there's 106 local employers, including the state of Kansas, that offer some police and fire plan, and it covers about 15,000 active, inactive, and retired members. So you may have a police officer, though, let's say for a city or a county, the governing body may decide to have that member still participate in regular KPERS, even though they're law enforcement, or they may elect to have them covered by police and fire, and it's a local employer decision. And then the judges, all the state judges across Kansas, not the judicial staff, but the judges, there's 564 active, inactive, and retired members in that 3rd plan, or that judges plan. Slide 9, just in terms of KPERS, there's 3 groups depending upon when they join KPERS. So KPERS 1 covers members who were prior to July 1st of 2009, and that's the largest group, but it's a closed group, and so as those members retire, that number is starting to decrease. KPERS 2 then, and we'll talk about the benefit differences in each one of these different groups here in just a minute, but KPERS 2 came out of the pension reform in the early 2000s, 2007, and it's for membership of July 1st, 2009 through the end of 2014. So it's a limited group, so it's only if they joined KPERS membership in that time period. The one exception is KPERS correctional officers are still eligible to enroll in KPERS 2. That's the only open group that can still join KPERS 2. And then KPERS 3 came out of the pension reform of 2012, and it's anybody that joined KPERS after January 1st of 2015, January of 2015. And there's 2 tiers in police and fire. It's prior to 1989 that didn't elect to go into tier 2. And of course, given that date, there's just a few hundred tier 1 members still active in KPNF. And then KPNF Tier 2 are for any members since July 1st of 1989. On slide 10 then, all of the KPERS plans are defined benefit plans. So a pension plan is a retirement fund composed of contributions from the employer, from the employee, and then with those investment earnings. And a member who goes through KPERS and has the prerequisite in terms of years of service, they are guaranteed a regular monthly benefit from the fund at retirement. Generally for KPERS 1 and 2 then, like most defined benefit plans, it's years of service, times final average salary of the member, times a multiplier of some point. KPERS 3, the newest one, is a cash balance plan, as it's called, and we'll talk more about that. It's technically still a defined benefit plan, but the account balance in the member's account determines the ultimate retirement benefit for that member. And then as we switch to system statistics on slide 12, again, just shows you there's a graphic there. There's about 156,000 active KPERS members. Over half belong to KPERS school, so about almost 89,000, followed by about 24% in local, 13% in state, and then judges and KPNF. We have active KPNF members, or KPERS members, excuse me, KPERS members as young as 17 and as old as 92. KPERS 1, and so that gives us all something to shoot for, to still be actively contributing to KPERS retirement when you reach age 92. So a person must really enjoy their job, I think, if they're still working at 92. KPERS 1, as I mentioned, is the largest group with over about 61,000. KPERS 3 is the second largest with about 58,000. But again, probably by next year, KPERS 3, just with in terms of retirements, new enrollments, will be the largest, probably the largest group. On KPERS, the average KPERS member has about 10.8 years of service and a salary of about $45,000 annually. Similar in terms of years of service to police and fire, and an average salary of $71,000. As you look to the retired side, so there's over 105,000 retirees and their beneficiaries. And you can see, again, as you'd expect, the school is the largest group out of those 105,000, with over half in the school group, followed by local and the state close behind that. Retirees range in age from 51 up to 109. Beneficiaries range from 15 up to 108. And I haven't checked lately, but a lot of times female school teachers as a group have a very long longevity in Kansas, and so I wouldn't be surprised if that 109-year-old retiree happened to have been a female school teacher in Kansas. The average KPERS retiree benefit is about $15,500 a year, so about $1,300 a month. About 3/4 of the KPERS retirees receive less than $2,000 per month, or a little less than $24,000 annually. KPNF retirees, different benefit formula we'll talk about. Their average benefit is about $38,500 per year, or about $3,200 per month. As you look at trust fund assets on slide 14, again, we bring in about $1.5 billion, again with the B, annually. Employees contribute about, in fiscal year 2020, about $450 million. Employers contributed over $1 billion. So that gets you to $1.5 billion, and then the annual investment income. This report looks at our latest actuarial evaluation. It's on a calendar year basis, so it was calendar year 19, reported to the board then last summer in July of 2020. And certainly some good news to share there, where the total return for calendar year 19 then was 17%. And so the expected return is a 7.75%. So certainly beat it that year. And the size of the trust fund is now over $23 billion with a B. Not as big as maybe it should be, but certainly headed the right direction, and certainly it's record highs when we get into that $23 billion level. And of course, as you know, the market can fluctuate, and so we might be up maybe even 100 million one day and maybe down 100 million the next. But that's I guess the beauty of being a long-term pension fund, trust fund. We're not day traders, and so we do have a 50-year investment horizon. So we know there'll be lots of ups and downs over the year. We talked about the Great Recession. But under generally the way it works, investments are down. Who has to make it up under a defined benefit plan? It falls to the employer. For KPERS 1 and KPERS 2, it's all borne by the employer through higher employer contributions, and we'll talk about KPERS 3, where it's more of a shared risk. Slide 15 talks about those investments. Of course, investments is the largest single source. About half comes from the investment side, about a little over a third from those employer contributions, and then about 17% from the members. And as you'd expect, if you had $23 billion to manage in your own assets and your own, you probably wouldn't have it all in your checking account. It's a well-diversified portfolio, so we have domestic equity, of course, international equity, fixed income, real return, real estate, alternative investments, and certainly cash to make sure we're always able to pay those monthly demands in terms of those retirement benefits. And just the monthly outgo, for example, we're just getting ready to pay. The KPERS retirement benefit is always paid on the last working day of the month. And so just today, we were working with our custodial bank. So they would send us about $140 million is what we need on a monthly basis to pay those retirement benefits. So just some big numbers. A lot of people count on KPERS. A lot of people count on those retirement benefits. And so you think about those 300,000 plus members active and retired. About 1 in every 10 Kansan has a direct tie to KPERS in some manner or another. And that doesn't talk about, you know, adult dependent or adult children or anything like that. This is direct membership or surviving spouse. We're still gathering the final numbers on the calendar year 2020, and it looks like our return in 2020 for calendar year is going to be 11.5%. And that chart on the lower right there on 15, you can see the 1 year, 3 year, 5 years so far. And that dotted line going across is that assumed rate of 7.75%. But if you look at that 25-year number, again, over the last 25 years, we've exceeded that assumed rate of return, 7.75, which is certainly on the higher end for public pension plans for that assumed rate of return. But, and you think back over the last 25 years, you think about the big downturns, the Great Recession, you know, the dot-com bubble burst, all those, certainly there have been some ups and downs, but looking back over 25 years, we're ahead of that 7.75%. The legislature through the years in recent years has tried to step up and try to strengthen the funding position of KPERS. And on 2 occasions, the legislature authorized the sale of pension obligation bonds. One was in 2004. The state of Kansas sold pension obligation bonds, went out on the market and sold them. They're really just interest arbitrage bonds. So the state goes out to the market and says, we want to sell some bonds. And in 2004, those bonds cost 5.39%. So the state says, we will pay the annual debt service on that one, about $33 million a year from Expanded Lottery Act revenue funds, the casino money. $33 million of that is dedicated to paying that bond debt service. The assumption is, so KPERS got the $440 million. In 2015, there was $1 billion in bonds sold. KPERS got a wire transfer after the sale of those bonds for $1 billion, and I always like to say that was certainly a good day around KPERS when we get a wire transfer for $1 billion after those bonds sold. And the interest rate on those bonds is 4.69%. So the state's paying that out of the general fund, about $60 million a year. So the thinking is, so KPERS has the $1 billion, state's gonna pay the 4.69%. KPERS will be able, hopefully over time, earn at least something better than that. And the assumed rate now is 7.75%. So the difference then between the 4.69% and the 7.75, of course, it's all in the trust fund, but the net position of the state is stronger because they have to put in less to KPERS because we've had the $1 billion to invest, and we have, so far, they're 30-year bonds, you know, and that one was 2015, the 2004, you know, it's been about 15 years, both to the good. But between those 2 bond issuance, after paying debt service, So after paying debt service, the net position of the state were $676 million to the good. So that means the trust fund's stronger. So that means the state has to put in less employer contributions. So it's a savings over there. Now, again, of course, that can change. Again, it's to the market. And even if the market goes down, the state's, of course, still on the hook for that debt service. And those bond holders expect that payment no matter what's going on in the market. And so the state, of course, would always make good on that debt service payments. But so far, those $1.4 billion in pension obligation bonds have worked just as it was originally intended and hoped. Again, they're 30-year bonds, but so far it's been very successful. Because of the bonds, because of increased employer contribution, gets us to page 17, and that's the funded ratio it's called. That's just looking at assets to liabilities. If it's less than 60%, then you're in trouble. Could be subject to a big downturn in the market. You can get in that spiral if you have one big downturn, maybe followed by another downturn, and then that funded ratio gets so low, the employer contribution would get so high, and then you got major funding problems. So if you're below 60%, the red lights are flashing, the siren's going off, somebody better do something. If you're between 60 and 80%, it should still be monitored, and the goal is really to be at a minimum 80% on your way to 100%. You really want to be fully funded. And you can see on that graph on 17, in 2012, we were below 60%, and this is for the state school group. We're at 56%, and now through good investments, through good contributions, we're at 70%. Slide 18 just shows you the funded ratio by group. So you can see this state, the judges is actually the highest funded ratio. Again, that's assets to liabilities. They're at almost 95% funded. And you can see that through the group. The state employee group only is also close to 80%. The school group is about 65%, and it's the largest share of that $9 billion unfunded actuarial liability. And the size of the unfunded liability, the largest single factor, it has been, until this year, for 25 years, the state, which pays the employer contribution for all, of course, state employees, but all local school employees, largest group, is part of state aid to education. The decision was made over those years to pay less than the actuarially required rate. So every year we'd get our actuary, employers, state, you should contribute at a certain level, and every year the policy decision ultimately was to contribute something less than that. The difference doesn't go away. It rolls to that unfunded actuarial liability. We're charging 7.75%, and it's not, if it'll be paid, it's when it will be paid. In this case, we're on a 40-year amortization period scheduled to end in 2033 or thereabout. 19, just again, we remind people, as the market goes up and down, retirees should never have to worry about, their benefits not being paid. The funds in the trust fund are very secure. I always say if there's a true lock box in Topeka, it's the Capers Trust Fund, because there's federal law, there's trust law, there's IRS law, there's state law, there's case law, all to protect not only the Capers Trust Fund, but really any trust fund. And so that money will be there, that those public servants have paid into and are deserving of a benefit. And so members do not have to need to worry about not getting their hard-earned Capers benefit. I might just, here's some retirement terms, and I'll just let you read through those, but that actuarial valuation, actuarial required contribution rate, that funded ratio, amortization that you may hear some about, that's kind of similar to a home mortgage, paying off that unfunded actuarial liability plan. And it's currently ours for the Capers State School to be 2033 in that time frame. And then just the difference on the next slide, the difference between defined contribution and defined benefit. Again, CAPERS is a defined benefit plan. Those people in the private sector, maybe like a 401k, that would be a defined contribution plan where a person puts in their money, the employer puts in their money, it's managed, and whatever's there, when the person gets ready to retire, that's what their retirement benefit's going to be. While a defined benefit plan, there's that formula, that guaranteed amount, and again, the risk in terms of cost really falls to the employer in a defined benefit plan, while with an employee, the risk is with the defined contribution plan. Cost of living adjustment for retirees, of course, and you may probably hear about that from time to time, but certainly for CAPERS retiree, the last one was approved in 2008, but you had to have been retired 10 years to get it. So any CAPERS retiree who retired from 1998 going forward has not received a cost of living adjustment, and that's not part of the plan design. Certainly in the 80s and 90s, there were very frequent ad hoc cost of living adjustments granted by the legislature, and it's a legislative decision in terms of that. On slide 24, then just kind of goes through the different plans, and I'll go through these kind of a good clip here too, but CAPERS 1, that defined benefit plan, again, it's membership before 2009, it's final average salary times that year's service times a multiplier at 1.85 before 2014, and that multiplier is 1.75. CAPERS members are vested after 5 years of service, so that means they're guaranteed to a lifetime benefit once they're eligible. And under a CAPERS 1 member, they have that 85-point plan. So whenever age and years of service reaches 85 points, they can have normal retirement, or age 62 with 10 years, or age 65 with 1 year. And there's some examples there. 20-year member, $14,200 benefit. 30-year member, a little over $21,000. CAPERS 2, again, 2009 to 2015 on slide 25. The structure's the same, final average salary times years of service. CAPERS 2 members, their multiplier is 1.85 for all years of service, vested after 5, but they don't have that 85-point plan that I mentioned, age and years of service. They have either age 60 with 30 or age 65 with five years of service. I will mention there's a sort of a subgroup within CAPERS, the CAPERS Correctional Group A and Group B. So this is for state correctional officers. Same benefit structure as CAPERS 1 or CAPERS 2, depending on their hire date. In Group A, it's usually correctional officers and their supervisors. Group B are the non-correctional people, but individuals within the correctional system that have kind of normal daily contact with inmates. So might be food service, maintenance, correctional industries. The big difference there for CAPERS correctional officers, they have an earlier normal retirement date. So those correctional officers can retire with an unreduced benefit at age 55 with 10 years of service. Group B, those other food service workers, maintenance, and so forth, they can retire, have a normal retirement at age 60 with 10 years of service. And so that's the CAPERS correctional. Then on slide 27 is CAPERS 3. This is this cash balance plan where it has some of the same attributes as a defined contribution plan, sort of like a 401k. The member puts in their 6%. The employer contributes pay credits kind of on a sliding scale, depending on how many years the employee has worked. So that makes it like the 401k, but on the cash balance plan, unlike a 401k, members, one, can never lose what they put into it, no matter what happens in the market, and they're guaranteed a minimum of 4% guaranteed interest on their contributions every year. And then there's, depending on how the market, how the trust fund done, there's a formula that I think Chairperson Johnson had some involvement with. It has lots of moving parts, but it's an average, so there's an opportunity for some additional that the members get to share in the dividend earnings for the KPERS plan. But KPERS 3 members have a normal retirement of age 60 with 30 years, or age 65 with five years of service. Slide 28 is just the comparison between kind of how there's certain defined benefit similarities, but there's also defined contribution plans similarities as well. And perhaps, again, the biggest factor is that sharing of risk. You know, KPERS 3 members have this notational account where it's tracked their contributions plus the employers. It's in sort of this hypothetical account within the big trust fund. And so, but whatever the value is in that notational account, that's then what's converted to a lifetime benefit when they get ready to retire. And slide 29 just shows you some of those steps to go through. Again, the member contributes 6%. They get the interest vested after 5 years. And whatever the balance is when they get ready to retire, that's what's converted into a lifetime benefit. Slide 30 just looks at police and fire. Again, you can see there the difference is they have a multiplier of 2.5%. So final average salary times years of service, instead of 185, like for most regular KPERS members, it's 2.5. They're vested though after 15 years, but you can see their normal retirement is different than for regular KPERS. It's age 50 if they have 25 years of service, age 55 with 20, or age 60 with 15 years. Their benefits are capped at 90% of final average salary, which is 36 years of service, and the disability provisions of KPNF are part of the KPNF retirement program, as opposed to KPERS where it's separate. It's a separate employer-funded plan outside of the retirement plan. Judges, there the multiplier is 3.5%. Their final average salary is 3 of the last 10. They vest immediately. They have a normal retirement of that 85 points, age and years of service, age 62 with 10, or age 65 with 1. Their cap is at 70%. And the difference, particularly between KPNF and judges, KPNF, it's the public policy decision was made that for the good of, I guess, the state, it's good to have a young, vigorous public safety workforce. And so you get them in and they can retire at an earlier age than others. Judges, the assumption was that a lot of them would join the bench later on in their legal career, and so they would have less time to accumulate, you know, a retirement benefit. And so I think those were some of the underlying thinkings that went into both of those things. And then the last slide is just on KPERS death and disability, 100% employer funded. It's normally, by statute, it's 1% of the total payroll contribution. It's a pay-as-you-go system. The governor has recommended in her budget recommendations a moratorium on that to sort of spend down those balances. And I believe the balances are there as long as you're comfortable with the pay-as-you-go system. And it's a separate trust fund. And there's, you can see there that the person there, if they're unable to perform their regular occupation for 2 years, and then after that, to continue to be on disability, they have to be unable to perform sort of any occupation, not just what the occupation they were doing at the time of the disability. And then there's a $4,000 death benefit for all KPERS retirees. So, Mr. Chairman, that's a lot of information, lots of slides, but certainly be pleased to respond to any questions you or the committee may have now or some other time.
Thank you, Mr. Director. And I think we will jump into questions, committee questions. Representative Collins.
Thank you, Mr. Chair. I had some questions, but you answered most of them. But you mentioned that the KPF retirement, you know, that type of work, you want a younger workforce, and so their age is younger. But is that mandatory? Do people in that program, are they required to retire at a certain age?
It depends on the employer. I know some local employers do require their KPNF members to retire at a certain age. Others do not. So it's not a KPNF mandate. It's up to the employer in terms of those retirement requirements.
All right, thank you very much.
Further questions? Representative Dodson.
Thank you, Mr. Chairman. I have a couple of questions here, and they're quite separate. One, my memory is, and I've been traveling for several years, so I've lost some of this, but some time ago, wasn't there borrowing from the trust fund and repayment at a rate of around 7%, as I recall? What's the status of that?
Right. Again, it's because it's a trust fund, again, the state can never reach in and take money out or borrow from it, but you collectively control the spigot of money coming into the trust fund. So in 2017, in 2019, for example, there were contributions, those regular annual contributions that the state was supposed to pay for state and local school employees. Because of budget constraints, the decision was made, can't pay them now, but both of those, so that's about 194 million one year, 64 million the other. Decision was made to pay those over the next 20 years. So it's about 25 million a year that was set up to come to Capers to pay for those delayed or missed payments. Now, the governor has recommended as part of her reamortization, her restructuring, to roll those payments into that unfunded liability and then reamortize that over the next an additional 10 years. But it was a delayed or missed payments being paid back over 20 years. Long answer to a good question.
I appreciate it. My follow-on was, I'm appreciative of the fact we've reached somewhere around 70%. I think that's good news. In one spot, you said employers and employees bring in $1.5 billion a year. Payout for 2020 was 1.9, and then you had assets listed as, in one spot as 23 billion, and then on your assets and liabilities, it was 21, and I assumed that included the bonds to make it around 2.3 or 23 billion.
And part of that is the lower number gets you back to that 2019 valuation, and so that's where the trust fund was at the time, and that's a lot of these numbers come out of that most recent actuarial valuation. The $23 billion is as of December 30th of 2020. So just a couple weeks ago, the trust fund over the last year has grown considerably, and so we're up to that $23 billion figure.
Yeah. Thank you very much.
Amazing.
Thank you, Mr. Chairman.
Representative Smith.
Thank you, Mr. Chair. I just wanted to compliment the chairman on the strategies that he used in 2016. So just wanted to thank the chair for what he's done. Thank you, Mr. Chair.
Well, thank you, Representative. Always a welcome comment. Appreciate that very much. Representative Proctor.
Thank you, Mr. Chairman. I'd just like to ask the question, so, and maybe it just didn't come out clear to me, but who manages the investments in this fund, and what's the interaction between that person and the board, or is it the board that's managing the funds?
Thank you, Representative. The board sets the guidelines, so the investment policy of that trust fund, so the mix, and of course there's some statutory provisions too in terms of how much can be in equities and so forth, how much can be in alternative investments and on down the list. But within that framework, the board sets the investment policy, and we have a staff of about 10 investment professionals then who help manage and keep track of over 30 then fund managers that specialize in different areas. So those external fund managers manage the money within the guidelines as set by the board. We have a staff to make sure they're doing what they're supposed to be doing and keep track of that. But there's external managers that manage it on a daily basis.
Mr. Chair, if I could get a quick follow-up. So what is it costing us to, with these external managers, what's kind of their fee structure?
It's cheap. How about that? It's, I think it's less than, is it 0.39, less than, it's less than 0.5% basis point in terms of the cost, and we can get you the exact cost, but it's just, I think, remarkable. Of course, if you have $23 billion and you're going to the market with those fund managers, it gives you a lot of leverage in terms of very competitive rates as they invest and manage that money. And most of them, we have a relationship that whatever the lowest rate they charge any other customer is what they have to charge capers. It's a contractual obligation that if they give somebody a good deal, we're going to get it too. And so, I don't know if Jared's dug it out yet, but maybe we can find it in just a minute. But it's very, very economical in terms of, and again, on investment that size, what those fund managers receive. Thank you, Jared. Our Jared Waltner, our Planning and Research Officer. The latest number is 0.15% is what those investment managers charge. So 0.15.
Thank you. Thank you, Mr. Chair.
Thank you, and thank you for the questions. And I know between the fund managers and the low administrative costs at Capers, it's a very cost competitive program. Any other questions, committee? Representative Miller.
Thank you, Mr. Chairman. Ms. Conroy, has the trust fund been able to weather the tremors of Senator Hensley drawing his retirement?
Thank you, Representative. Any other questions or comments? Well, a couple of things that I would be interested in, we can do them later. I wondered what the difference between the retiree and the beneficiary was for the age of 109 and 108, but I don't need to get too deep in the weeds.
So I'm just the age, or how we got there, or the?
No, the 109, is that when someone retired, or a retiree versus a beneficiary?
I'm sorry, that's the retiree who's retired but still actively drawing a retirement benefit.
Very good.
And the beneficiary might be a surviving spouse or
great,
somebody like that.
Great, thank you. So our 92-year-old still has a long retirement to look forward to. So thank you. Along the lines of Representative Dodson's question, looking at $21 billion being our assets at the last actuarial valuation, there is some market change from that and some deferred gain to be smoothed in. We will get that next information in the July actuarial report, or does that come any before that time?
It would be, well, the next July would be the next time. I mean, we can dig out what was in the last valuation in terms of that smoothing, but yes. So last year's available, and here in a few months we'll have the most recent.
Yes, always exciting to see that market value meaningfully above the last actuarial valuation to know the direction we're getting to go. So on the last slide topic, you had the Death and Disability Fund, and we often are able to have a moratorium on that, and it seems that we can do that safely most years. Is there a balance in that fund that is separate that we're able to rely upon?
Yes, there is. And it is a separate trust fund, just death and disability, so it's not mixed in with the retirement trust fund. separate trust fund, all employed by employers. And yes, there is a balance, and we can get you the exact numbers, but even after a year moratorium, there's still adequate balances to pay a normal, more than 1 year's normal, disability payments. And there is a safety valve should something catastrophic happen. There's a mechanism to get some additional money into that fund.
So thank you. Committee, are there any other questions? Seeing none, Director, thank you. While we're not taking the matter up today, if it is convenient to go over the one-page analysis that you put together relative to the change in age, it doesn't have to be right now. If it's convenient to you, it can be right now.
I'm sorry, on the KPNF disability benefit?
Right.
Yes. Your preference, certainly prepared to do it if now's a good time.
If you are ready and want to just give us a quick flyover, that will give us some information as we prepare for next Monday.
Right. This is on that KPNF, so them additional information on House Bill 2063 that you heard Monday, and there were some questions, and so we went back. Our chief benefits officer went through death certificates, trying to make sure we kind of captured all the correct information. And just a reminder there that under KPNF service-connected, several diseases are presumed to be service-connected. So heart disease, blood-borne pathogens like hepatitis, a number of cancers, just because of the work they do and the stress, is assumed to be work-related or service-connected benefits. And so based on that last valuation, there's about 7,800 active employees. We have 192 KPNF members receiving those disability benefits. Each year, there are approximately 20 or 30 approved disability claims out of that roughly 8,000 member pool. And over the past 5 years, there's been about 13 disabled members who have died. And I should comment too, if a person is disabled and they reach normal retirement under KPNF, then they're converted to retirement benefit. Under current law, it doesn't make any difference what the disabled member dies from, whether it's service-connected or not. But going back through those death certificates and other information we have, we were trying to be responsive to the question, were there any other members that might qualify out of those 13 that we mentioned over the last 5 years. And going through it, it appears, based on the information that we have right now, that there were a total of about 3 over the last 5 years. The one you heard from about yesterday, on Monday in 2019. But looking through the information, it appears there would have been, if this law was in place, 2063, there would have been 1 in 2017, and then there was just one that happened here in the last couple months in 2020. So out of the last 5 years, there appears there would have been 3 disabled members who died from a service-connected that their survivors would benefit from the increased benefits under 2063.
So thank you for that overview. I hope that answers some of the questions we may have had regarding that topic. In interest of time, I may have folks that have questions on that to catch our CAPERS staff after the meeting to move through our 2 hearings, if we may. So thank you for that information. So that brings us into our hearings, and we could actually go either way. Director Conroy, would you like a 2-minute rest so we could do the other bill and come back to you? Or so with that, we'll actually step to House Bill 2134. And I would ask for an overview from the reviser. I was hoping you could maybe read us the entire bill real quickly.
Thank you, Mr. Chair. I didn't take Evelyn Wood's speed talking class, but I'll try my best for you. House Bill 2134 is updating the National Association of Insurance Commissioners Credit for Reinsurance Model Law, the Insurance Holding Company Act, and it codifies the credit for reinsurance model regulation. House Bill 2134 creates one new section of law and amends KSA 2020 Sup 40-221A, 40-3302, 40-3304, and 40-3306. And Section 1 would create all new law by codifying the National Association of Insurance Commissioners Credit for Reinsurance Model Regulation into statute. And Lee from the Insurance Department will explain why this codification was necessary. Section 2 amends KSA 2020 Sup 40-221A, which is the state's credit for reinsurance statute. And under current law, a domestic ceding insurer is permitted a credit for reinsurance as an asset or reduction from liability when it's ceded to an assuming insurer if the ceding insurer satisfies one of 6 different conditions that each have different requirements that must be met in order for the ceding insurer to receive the credit. Senate Bill 28 would add an additional condition under which such a credit may be permitted. And the requirements of this new condition are listed in the bill on page 42. Section 3 amends KSA 2020 Sup 40-3302, which is the definition statute of the Insurance Holding Company Act. The bill adds 2 new definitions to the statute. The first one is the definition of group-wide supervisor, and it's defined to mean the regulatory official authorized to engage in conducting and coordinating group-wide supervision activities who is determined or acknowledged by the commissioner under KSA 40-3318 to have sufficient significant contacts with the internationally active insurance group. And what is an internationally active insurance group, you might ask? Well, that has been added as a defined term to mean an insurance holdings company system that includes an insurer registered under 40-3305 and that meets the following criteria. It must have premiums written in at least 3 countries. The percentage of gross premiums written outside the United States is at least 10% of the insurance holding company system's gross written premiums. And it's based on a 3-year rolling average. The total assets of the insurance holding company system are at least $50 billion, or the total gross written premiums of the insurance holding company system are at least $10 billion. Section 5 amends KSA 2020 Sup 40-3304 of the Insurance Holding Company Act to require that any controlling person of a domestic insurer seeking to divest its controlling interest in the domestic insurer file a confidential notice of its proposed divestiture with the commissioner and with a copy to the insurer at least 30 days prior to the cessation of control. The bill would also require the commissioner to determine those circumstances under which each party seeking to divest or acquire controlling interest in an insurer to be required to file for and obtain approval of the transaction. Finally, the bill would require the acquiring person to file a pre-acquisition notice with the commissioner containing information in the form and manner prescribed by the commissioner and rules and regulations. These requirements are not a part of current law and would be new language added to the statute. And with that, Mr. Chair, I can stand for questions.
Thank you for the overview, and thanks for a thorough overview that was much shorter than the thorough bill. I appreciate that. Committee questions? All makes complete sense, right? All right. Representative Neighbor.
Eileen, thank you for your excellent description. This is something that we also saw last year, I believe, come before us.
We did. I think this is part of the department's legislative agenda that didn't make it through due to kind of the abrupt nature of the session ending last year.
And that was what my thought was. So what you've done is essentially taken that bill and added in the new parts, the definitions, and compliance issues, and that's what this bill is then.
Right, and Lee will speak to the whole package, but yeah, that was what the drafting request was.
Thank you, and thank you, Mr. Chairman.
Further questions, committee? If not, thank you for the overview. Appreciate that.
My
I don't
pleasure,
bel-
Mr. Chair.
Thank you. I don't believe that there is any fiscal note that relates to this, as we're, other than the printing of the paper may have to be there for the 2 or 3 copies. But with that, we would then move into our conferee testimony, and we would welcome Lee Modisett.
Thank you, Mr. Chairman, members of the committee. Lee Modisett with the Kansas Insurance Department. I apologize that following the CAPERS presentation, I have another complex piece of legislation to consider. Director Conroy did a great job overviewing that, but I imagine that you all are ready to get ready to wrap up the hearing, so I will try to be as brief as possible. I thought I might start with the smaller piece of this bill, which is the Insurance Holding Company Act, for just kind of a brief summary of that. This is, the Holding Company Act was already established law. We had to add a couple of definitions and other updates to this. There is a regulation that was already established that required updating as well. We have gone through that rules and reg process. We've had our public hearing, shared this with industry, the folks that would be impacted, the whole 9 yards. We had no public comment either at the hearing or written, and no issues or concerns through the Rules and Regs Committee. The rest of this bill deals with credit for reinsurance, the vast majority of which, as Eileen mentioned, is the adoption of the model reg. You might be wondering why we chose to do reg and statute as opposed to going through the rules and reg process. The simple explanation for that is the established credit for reinsurance statute had to be updated anyway, and so we felt it prudent to include the regulation element with the statutory update. What all of this in legalese means to folks like myself that is not an attorney and trying to understand the objectives here is that the US and the EU are 2 large markets for reinsurance. For those folks who don't know what reinsurance is, it's simplified. Company A, who has written a certain amount of premium volume and has done their risk calculation, may decide that they want to unload some of that risk and sell that, unload that to a reinsurer who then takes on that portion of their business. And this dates back to a Dodd-Frank legislation that was passed dealing with covered agreements. The covered agreement deals specifically with reinsurance because the US and EU are large markets for the reinsurance product. This ultimately leads to both entities wanting to do business in each other's country. There was an agreement in 2017, and then with the UK deciding to leave the EU, a separate agreement made with the UK in 2018. And all of it basically says, as simplified as I can explain it, is if you want to offer reinsurance, there was a previous requirement for collateral. This eliminates that collateral requirement so long as you can still prove financial solvency in another manner. And so the benefit to that is that it would open up and expand the credit for reinsurance market, or the reinsurance market, while also maintaining adequate consumer protection. These 2 things together are part of the NAIC's accreditation process, which we are up for later this year. You may remember from the commissioner's presentation that we go through this process every 5 years. The gist of the accreditation process is that in order to preserve this state-based regulation of insurance, there needs to be some level, some baseline of uniformity across the states. We want to know that Kansans who are buying policies written by companies in California, that California is adequately overseeing their companies, and vice versa. They want to know that any company domiciled in Kansas has adequate oversight. So this accreditation process is essentially the baseline establishment that we have done that within reason. And these two pieces are an element of that accreditation. So with that, Mr. Chairman, I'd be happy to stand for questions.
Thank you for your overview. Committee questions. Representative Neighbor.
Thank you for your great testimony. My question today is, we have a lot of new members on this committee, and this is a rather lengthy bill that I'm sure everybody could read over the weekend, but might not be high on the reading list. Could you explain a little bit about NIAC or the National Association of Insurance Commissioners, and that we are members of that group, and what they really do to connect insurance commissioners across the United States?
Sure. Thank you, Representative. That's a good question. Yeah, so the NAIC, National Association of Insurance Commissioners, is made up of the insurance commissioners or directors in all 50 states and 6 territories. Any sort of model legislation that comes out of the NAIC has gone through a multi-tiered committee process and has engaged industry, and ultimately has to be voted on by the membership, which again is the commissioners. The NAIC, the organization itself, is tasked with making sure that what the individual commissioners have agreed to collectively, that is actually taking place in practice across all the different insurance departments. And kind of to what I was alluding to earlier, the primary purpose of that is, if we only had Kansas companies selling to Kansans, we would have less concern about this, right? But we live in not just a multi-state, but a global economy. And so it's important for all states to know that the companies that they don't have direct control over, that the consumers who are buying those products that are written on paper from a different state, that there is adequate oversight. And so the entire organizational structure is designed with that concept in mind.
Thank you. Thank you for your explanation, and thank you, Mr. Chairman.
Thank you for the questions. Representative Dodson.
Thanks, Mr. Chairman. This may not be quite the same, but I'm trying to kind of capture what the idea is. When we had the recent recession, if we recall, AIG was the kind of the reinsurer for banks. And the problem was they were under collateralized. So the only way that banks could really be preserved was for the government, U.S. government, to inject money into AIG. The ones I worked with before, Lloyd's of London and Grubb and folks like that, is that the category of reinsurers you're talking about? And if so, I found it very, very difficult to ensure that the liabilities that groups that large have was knowable.
So that's a good question, Representative. And certainly the Dodd-Frank legislation that dealt with this covered agreement and reinsurance, the whole thing is in response, good, bad, or indifferent to 2008. One of the largest reinsurers that comes to my mind is Swiss Re, right? So there's a number of reinsurance providers depending on the particular product or what they're trying to reinsure. And so this is trying to get at, and what it's trying to get at is allowing more competition, if you will, and more choices in the marketplace for companies.
Thank you, I appreciate it. Thank you, Mr. Chairman.
Thank you, Representative. Representative Howe.
Mr. Chairman, I had a question as it relates to the fiscal note provided by Adam Proffitt, Director of Budget. In the letter, it says that it would require states to eliminate collateral requirements within 5 years or be subject to federal preemption. Could you elaborate a little bit more about what those collateral requirements would be? And how that affects these insurance companies?
Sure, thank you, Representative. The issue with the collateral requirements was that if you were what I'll call a non-admitted company for reinsurance. If you wanted to offer reinsurance, you not only had to be a solvent company, but you had to have collateral above and beyond that. And that made it prohibitive in some cases for reinsurers to offer their services. So this would actually be removing that collateral requirement, again, while maintaining our ability to ensure that the company is financially sound through actuarial analysis that I am not near smart enough to understand, and I'm glad we have staff that do. The federal preemption component deals with this Dodd-Frank legislation that discussed the covered agreement. The NAIC at kind of rapid speed developed this model act and model reg. Should we not adopt that, we would have a accreditation issue. But if we deviate too much from the model language, we also run the risk of federal preemption from the Federal Office of Insurance, because this is an agreement between two countries. And so the EU and the UK were willing to essentially honor our state-based structure and regulation of insurance, so long as there was this consistency in this particular segment across the states. And so that's why the note is in there on the in the fiscal note of the timeline and the significance of it.
Thank you.
Thank you, Representative, and thanks for also clarifying. I misspoke earlier. There is a fiscal note, but in the fiscal note, there is no fiscal effect that was noted, but thank you for raising that question. Any other questions? With this being our live conferee, this is our chance to ask any questions that we have or request information that might be needed. And seeing none, we'll certainly continue to work on our homework. Thank you for your testimony.
Mr. Chairman?
Yes.
I apologize. I did have one more question if you had a moment.
Please, and my apologies to not continue, Representative.
Thank you, Mr. Chairman. Is it common for Kansas insurers to do business with qualifying European Union insurers? If so, could you give us some examples of what type of companies we're talking about? Thank you.
Yeah, that's a good question. I don't know if I can, I'll see if I can get you an answer to that. Certainly we look at the solvency of companies, but I don't know that we get down into the granular level of who their reinsurers are. But let me see if I can find that.
Thank you.
Thank you. Any further questions? Seeing none, thank you, and thank you for that follow-up. So we also have proponent testimony from Tyler Laughlin, American Council of Life Insurers. And if you have a chance to read through that, that will provide some of their perspective. Is there anyone else wishing to appear as a proponent of House Bill 2134? And hearing none, we would move to opponents. I have no listed opponents. Is there anyone wishing to appear or speak as an opponent of 2134? Anyone neutral or anyone else at all on 2134? Hearing none, we will close that hearing. Thank you to our conferees, our reviser, our proofers in this case, and to the committee in working through this issue. It is possible we will look at taking this up on Monday also, so work through the questions that you have and raise them if they are there. But with that, we will move to our next item, which is House Bill 2064, and would ask Revisor Weiss to take us through a high level of that one.
Thank you, Mr. Chairman. Good afternoon. House Bill 2064 concerns the drop program that you heard about a little bit on Monday. This is the second of three bills that was recommended by the Joint Committee on Pensions, Investments, and Benefits last December. This would allow a member of the Deferred Retirement Option Program, or DROP, who previously elected a drop period of less than 5 years, to revoke such election and extend the member's drop period by making an application to the KPNF retirement system. The total aggregate drop period for a member would remain at 5 years from the effective date of the member's initial election to participate in drop. So if somebody had initially 3 years, you know, they can't go out and try to extend another 5. They'd only get an extra 2 years, basically. So they're still capped at the 5 level, at the 5-year mark for drop participation. Under current law, a drop member makes a one-time irrevocable election to participate in drop. And there's a minimum for the 3 years with fixing, like I said before, a maximum of 5 years you participate in drop. With that, Mr. Chairman, I could stand for any questions.
Thank you. Committee questions? Seeing none. Thank you for the overview. And we will move to Director Conroy to give us an update from the department and their position and background.
Thank you, Mr. Chairman. House Bill 2064, you've heard David's done a good job explaining it, and you heard from Melissa on Monday from the Joint Committee's recommendation. Again, drop program, the person is either highway patrol troopers or KBI agents. They enter in, and it's certainly currently a pilot program that will sunset now in 2025, and the member can enter in the drop program with the agreement of the employer for 3, 4, or 5 years. If they enter in, then the employer and the member continue to make their regular contributions to KPNF, but the retirement benefit in terms of additional service is frozen, and so their monthly retirement benefit during the drop period goes into a separate account, and then at the end of the drop period, it's paid to the individual. There's possibility of some interest. As David has indicated, this proposed change then would allow somebody who enters in with, let's say for a 3-year drop, at the end of the 3 years to extend it either 1 or 2 years up to 5 years, and that cap's still there. We've checked with our actuary on page 2 of my testimony, the projected costs, and really, since the drop program impacts behavior, you really can't tell if people are retiring sooner or if they're delaying retirement, which then gets to the cost of the system and the ultimate impact from an actuarial standpoint. This does give them some additional flexibility, and so you know, I guess there's some chance they may retire just a little bit sooner, but again, we don't know that, and I think that's one of the reasons the whole sunset period was set up to get some actuarial experience, perhaps before making it permanent. 5-year cap remains. We do have a couple policy questions, and the one currently right now for a member to enter drop, the member, of course, and the employer have to reach agreement before that drop program starts for the member. We're not sure that this current version of the bill requires the employer to approve it. It seems like it could be interpreted that the member gets to decide and the employer doesn't get a chance to weigh in terms of whether that drop period should be extended or not. I'll just mention to you, I've had conversations with the director of the KBI, and I think he had a similar concern about that in terms of should the employer be involved since it's an employment decision. I think CAPER's standpoint is clearly it's an employment decision. It's not appropriate for CAPERs to be involved in determining whether a person should be in or out of the drop program. And that'd be something, I guess, we'd suggest that the member and the employer work out. And then one other, and this is getting a pretty fine point, we're not sure the bill says that if a person decides to extend the drop program, maybe they've been in 3 years, could they have a break? So maybe they just go back to regular work for maybe a year or two, and then enter in for an additional 2 years. They'd still be capped by the 5 years. We have received our tax compliance counsel, that Ice Miller firm I mentioned, said that they believe this would violate those IRS requirements because it'd be viewed as, it's called an in-service distribution, violate the Internal Revenue Code. And so I think that could be addressed if it was clear that if the drop period is extended, it had to be continuous. So if somebody was in 3 years, wanted to do 2 more years, it would have to follow right after the end of the 3rd-year period. So a couple policy questions for you. I'm certainly be glad to respond to any questions about that or just drop in general. I will tell you, we've checked, and of those currently in drop, 31 of them entered in for 5 years. Only 6 entered in for a 3-year period, and only 2 entered in for a 4-year period. So of the 39 that we ran the data on, 31 for 5 years, 2 for 4 years, 6 for 3 years currently.
Thank you for the overview. Representative Neighbor.
If these 2 amendments were brought in a balloon amendment when this is discussed, would this make the Capers Board feel more confident in that it takes care of those policy questions and would hold up better?
I believe so, and particularly on the IRS compliance issue.
Right. One more question. Mr. Chairman, can we ask our revisor, since they're technical in nature, on the one for making sure there is no gap in there, could we get a balloon in there that would cover that for IRS compliance? Could we have you do that?
Mr. Chairman?
Yes, please, Mr. Weiss.
Yes, I mean, I could prepare a balloon to that effect.
Has it been done already?
No, I don't have.
Okay, I'm not asking you for redundantry or anything like that. And the other is, if we could put also in that balloon the issue that was first considered, and my mind just went blank, God forbid, the employer to weigh in. I think having a partnership between the employer and the employee makes it much more solid, and it gives a better definition to what is expected. And if we could get both of those when this bill is worked before this group. Thank you. Thank you, Mr. Chairman.
Thank you. Committee, other questions for Director Conroy? I would just follow up as Representative Howe.
Mr. Chairman, as I understand it, this started off as a pilot program back in 2016 and was then extended once more to 2025. Is there a reason that it may need to be extended beyond 2025, or is there a reason just to sunset it?
Mr. Chairman, thank you. I think it'd be a policy decision for the legislature if you want to continue the program. I think our actuary thought 10 years of sort of real life experience in terms of utilization of the DROP program, then she would be able to provide a clear actuarial impact on the DROP program looking at a 10-year period. Actuaries always like to have that longer period to make their determinations, but there'd be more complete data at the end of the 10 years, but then it'd be up to the legislature clearly as the policy decision. Do you want to extend it or continue it, make it permanent, or another sunset, or in the program, of course?
Thank you.
Thank you, Representative Howe. Representative Miller.
Thank you, Mr. Chairman. Just to expound on that, the interim committee actually talked about that, and then the conclusion was we wanted to wait till close to the expiration before we decided, 1, to extend it, and 2, to expand it.
Thank you for that additional clarification. Other questions? I would spend just a bit more time on the differences. Did I hear you mention that the bill might have been slightly different from last year's version on either of those 2 points, or is that just something else that we needed to try and catch? And the 2 points being the employer weighing in or the Ice Miller concern.
I'm sorry, Mr. Chair, I'm not sure there was a similar bill. I don't believe there was a similar bill last session. So
Okay.
this is a new bill.
I apologize.
Yeah, Mr. Chairman?
Yes.
Yeah, this was a new bill for this session. This is not the reintro.
So thank you. And I know that the recommendation did come from the interim committee, and I remember being there, but was there someone, looking at our list of proponents and opponents, was there someone who had asked about that extension? How did we get to looking at going from 3 to 5?
Mr. Chairman, I'd have to go back and review the notes from that meeting, but I'd have to get back with you on that to see exactly who made the motion. So
More than fine, and something I can check into as well. So I appreciate that. I would agree with Representative Neighbor if we could come up with the work on the employer weighing in, and certainly addressing the continuous employment for the tax concern. And I know we're trying to grapple on the fiscal note overall on this, and it was mentioned that someone might retire earlier on this one, and it's hard to get a handle on it. But could the flip side also be true with this, in that if someone chose a 3-year period to retire and then would extend, might I actually wind up with some people working longer than they might have originally intended in this scenario?
That's correct, Mr. Chairman. It certainly could play out that way. And again, it gets you back to that retirement behavior of the members as they try to figure out what's best for their position.
Thank you. With that, any further questions? Oh, Representative Neighbor.
Mr. Chairman, and I think, Alan, you, during your discussions, you said that this may be an incentive to keep those people that have the talent and the experience in office longer. That also allows for people to look for replacements and have time to educate them or bring them on board. So was that part of the intent, I think you said, of this bill?
Yes, I'd agree. I think on both those points, it was sort of a continuing employment tool to give the patrol and the KBI as they faced, particularly patrol on shortages of road troopers, as I think is kind of started out that way.
Thank you, and thank you, Mr. Chairman.
Further questions for the director? Hearing none, thank you for your testimony and bringing us up to speed on 2064. With that, I would move to our testimony. Do we have any proponents for the bill? Hearing none, do we have any opponents for the bill? And hearing none, anyone wishing to testify neutral? Anyone else at all? No further conferees. We will close the hearing on House Bill 2064. And committee, that is our work for today. We will work some of these bills at the beginning of Monday and then move into a couple of hearings then. Thank you for your work and have a good weekend. We're adjourned.